Very important concept we are going to discuss here. That is about measurement of revenue. Um, See, what happens here that it is quite normal that sometimes that businesses they transfer the goods or provide services at one point in time, and the payment is received at some other point in time, maybe later on, maybe earlier. We are going to discuss two examples or two important aspects of this scenario. So what you need to understand that there are two things. One is that point in time when you deliver the good, and the second one is when you receive the payment, and there might be a difference. IFRS 15, it provides guidance that revenue should reflect that amount or value when the control is transferred. When the control is transferred. And this actually, this one principle of control is transferred, the value at the control date, that would give rise to another concept which you call financing component, significant financing component. See, the first example is quite common. You have done it probably many times that maybe you deliver some goods to customer, and the customer promises to pay you at the end of year two. This is year one, this is year two, and the customer says, I'm going to pay you $10 million in 2 years' time. So, what we do, I mean, those of you who have done IFRS 15, you know that we need to find out the present value, because the present value of this amount, which is to be received in 2 years' time. And let's suppose that present value comes out to be 8 million. So we say that the revenue which we should record is 8 million. And then we amortize it or we unwind it. And that difference of 2 million, we call it as our finance income. Okay. Because we said that we have provided finance. We have provided finance to the customer. So the value of this particular equipment or whatever you sold the good, that is actually 8 million. The remaining 2 million is the time value of money, and this is finance income. So in your books, you record the revenue at $8 million. Okay. So why did you discount it? Why did you find out this value of 8 million? The idea is the same, that this is the point when you deliver the goods. So the value of the good is when you transfer the control. So on this particular date today, when I transferred the control, the value, assumed value based on the present value concept is 8 million. Now that is quite common, and probably you are familiar with this thing as well, and you record finance income. Now there is another scenario which is actually a little bit unique, but that is also practically not uncommon. Now, this was where you provided finance to the customer, okay? And you are recording the finance income and of 2 million, and 8 million goes as the revenue. An alternative way is an opposite of that. Imagine that you are you are in a construction business and you make apartment blocks, okay? You make apartment blocks or you make anything which is related to construction. That takes time. It is year one, it is year two. Now the terms of the contract are that it takes 2 years to complete, 2 years to complete the project. It takes 2 years to complete the project. Customer can pay you today 8 million, or in 2 years time 10 million, when you will deliver the good. So you actually say that either you pay me 8 million today or you pay me 10 million in 2 years' time. Remember, the delivery of the good is done here. The delivery of the goods is done in 2 years' time. Now the question is, the customer has actually agreed to pay you 2 million today, 8 million today. So you have received 8 million. But when you receive this 8 million, you have not delivered the goods. So that 8 million, it goes as your liability. You can call it liability here because you have received the money and you have not delivered the goods. Again, based on IFRS 15, it says that revenue should be measured when the control is transferred. Control is not transferred here. The control is transferred after 2 years. And what is the value of that thing after 2 years is 10 million. So in this case, the revenue should be recorded as 10 million. So revenue is not going to be 8 million. This is the amount you have received, but you have received in advance. And when you will transfer the goods, on which date? After 2 years' time. And on that particular date, the amount is $10 million. So revenue should be $10 million. This is number one. But it does not end here. Now, before, in the previous example, you were recording finance income. This time, what is happening that you are not providing finance to the customer. Actually, the customer is providing finance to you. It's the opposite thing. Customer is providing finance to you because customer is giving you 8 million in advance and say that, okay, take this money, 8 million, go and do the construction job. So if you are taking advance, which I can consider it as a loan from the customer to construct an asset, which of course is a qualifying asset. So here comes IS 23, the borrowing cost. Now that is the twist to this situation. Borrowing cost will come in. So what will happen that you have to unwind it at your borrowing rate, whatever is your effective interest rate. And that 2 million, which is the difference between these two, it is actually going to be capitalized onto the value of the asset. And that 2 million is not finance cost. It is not interest expense. It should not go into your P&L. Actually, it should be capitalized onto the cost of the asset so that you have an initial liability of 8 million, plus you will make this 2 million, and then your total value of the asset will become also, because 8 million was the construction cost goes and 2 million will be added as the borrowing cost. The asset will become 10 million. The liability will become 10 million. Then they will be swapped or switched and you will record the revenue as 10 million. So what we need to learn here, that whenever there is a difference in timing, the measurement of revenue should be done on the date when the control is transferred. So always pay attention, when are you going to transfer the control? The amount of revenue should reflect the value on that particular date.